The United States government has taken a monumental step, one that signals a significant shift in a deeply entrenched financial system that has persisted for half a century. For decades, the financial establishment maintained the illusion that the price of silver was controlled by systems at play in New York. Paper contracts, high-frequency trading algorithms, and derivative leverage were touted as the pillars of price discovery. Physical supply? Insignificant, they claimed. There would always be enough metal available to meet demand. But today, Wednesday, January 14th, 2026, that facade crumbled entirely. The United States Mint, the sovereign body responsible for producing constitutional coinage, has officially announced the suspension of all sales of its silver numismatic products. At first glance, this communication might appear to be just another ordinary update from a government agency. However, upon closer inspection, the message reveals a much graver reality. It signals the collapse of a critical financial and operational mechanism within the national system. The official explanation for halting sales points to pricing adjustments due to soaring silver prices. The Mint claims it needs time to reassess how best to price its products. This is no temporary glitch, nor a mere website error. It is a physical default at the highest level of governance. The inability of the Mint to determine the real-time pricing for a standard 1-ounce silver coin signifies the market S volatility has surpassed what government systems can manage. The listed price on electronic trading screens, $89 towards $67 per ounce, is moving too quickly for bureaucratic processes to keep up. But this development suggests a deeper concern. When organizations cease selling a product during a period of rapid price escalation, it is usually because replenishing inventory goes beyond their means. If the U.S. Mint sells a silver coin for $100 today, and the market price jumps drastically tomorrow, for instance, to 110, they not only lose on the transaction, but also find themselves unable to source fresh silver to restock inventory. This scenario points toward an alarming reality. In these conditions, selling physical silver effectively liquidates national wealth in exchange for weakening paper currency. Simply put, silver is now more valuable than dollars. The suspension is an unmistakable warning, a fail-safe measure marking an emergency at an institutional level. It represents the point of divergence where paper valuations and physical commodity realities collide so violently that standard systems seize entirely. We have now entered what is known as the no-offer phase of an overwhelming bull market. Imagine this. You walk into a grocery store where shelves are fully stocked with milk and bread. But when you reach the checkout counter, you're told no sales can be made because prices are rising too quickly. The owner refuses your cash and consciously decides to keep their inventory instead of exchanging it for depreciating currency. This scenario mirrors the decision made by the United States government today. The refusal to sell silver demonstrates the failure of confidence in the dollar and sends shockwaves across all connected networks. Private dealers relying on the United States Mint as their anchor, AppMax, JM Bullion, SD Bullion, are now grappling with intense uncertainty. With the Mint halting operations, dealers face reduced supply of silver eagles, one of the most recognized coins globally. This has triggered a scarcity cycle. Premiums are being driven higher as dealers ration what little inventory remains because replenishment from the government is now off the table. Silver eagles, whose supply was tied closely to government production flows, have already decoupled from spot prices, pushing real street costs above and beyond. As all eyes turn to market figures, silver prices are continuing their meteoric climb during this freeze. Trading at $89.67 per ounce at present, silver has jumped another 4.50 in just one day, a 5% increase, with no signs of slowing down as we near 90 per ounce. Traders interpret this moment as an opportunity. Noticing that even governmental sources are scrambling for secure supply has emboldened bullish sentiment further. The psychological threshold of 90 beckons eagerly to the eventual breaking point at 100, a level that promises transformational impact. With sales suspended by the Mint, a substantial portion of intended retail supply remains locked away in vaults rather than reaching public buyers today. But demand does not simply dissipate because availability decreases. Rather, it intensifies. Those who wish to purchase silver eagles are now even more driven by scarcity, pushing them toward other alternatives and inflating prices across related products. What began as a suspension due to pricing adjustments may well become a historical turning point in global financial systems, a stark reminder that even the most established structures are vulnerable when trust erodes and physical reality outstrips financial abstraction. It will spill into bars, it will spill into rounds, it will spill into the broader investment market. It creates a vacuum effect. The United States government has inadvertently launched the biggest marketing campaign for silver in history. By telling you that you cannot buy it, they have confirmed that it is the most valuable asset you can own. So, where do we go from here? The Mint says they will resume sales once pricing has been updated. Do not expect that price to be lower. When they reopen the window, the price will likely be substantially higher. They are repricing for a new reality, a reality where silver is a triple-digit asset. This event is the demarcation line. Before today, we were in a supply squeeze. After today, we are in a sovereign crisis. The entity that prints the money cannot find the metal. If that doesn't tell you everything you need to know about the state of the US dollar, nothing will. The mint has folded. The dealers are rationing and the price is vertical. But if the mint closing was the defensive move by the establishment, what is happening in the commercial vaults is the offensive move by the whales. While the government was shutting down retail sales, a massive entity drained 1.3 million ounces of silver from the vaults of JP Morgan Chase. In the next section of this deep dive, we are going to analyze the JPM drain. We are going to look at who has the power to withdraw that much metal in a single day, and why the drain of the eligible category is the death nail for the COMEX pricing mechanism. The government is hiding the metal. The whales are taking the metal, and you are left with a choice. Do you believe the official narrative, or do you believe the empty shelf? If the suspension of sales at the United States Mint was the defensive move, what happened in the commercial vault yesterday was a massive offensive move. While the average American was being told they could not buy a 1-0 coin, a single entity operating in the shadows of the wholesale market walked into the most secure vault in the world and removed over 1.3 million ounces of silver. We have analyzed the daily depository statistics from the CME Group released late yesterday. The data confirms a coordinated raid on the stockpile of JP Morgan Chase. JP Morgan is not just another bank in the silver market. They are the fortress. They are the custodian of the largest hoard of silver in the COMEX system. For over a decade, their vaults were considered the backstop of the market. The assumption was that no matter how bad things got, JP Morgan always had the metal. Yesterday, the fortress was breached. 1,302,87 ounces of silver were physically withdrawn from the JP Morgan vault. This metal was not adjusted. It didn't just move from one accounting column to another, it was withdrawn. That means it was loaded onto armored trucks, and it left the building. It is gone. It has left the COMEX ecosystem entirely. Who has the power, the capital, and the logistics to move 40 metric tons of silver in a single day? This is not a coin dealer. This is not a retail investor. This is a whale. This is a sovereign wealth fund, a central bank, or a massive industrial conglomerate. And it wasn't just JP Morgan. The data shows the bleeding is systemic. 600,000 ounces were withdrawn from the Brinks vault. 200,000 ounces were withdrawn from the CNT vault. 259,000 ounces were withdrawn from the Loomis vault. In total, across all depositories, the COMEX lost nearly 1.8 million ounces of silver in a 24-hour period. This is a bank run. But instead of people lining up at an ATM to withdraw cash, we are seeing strategic entities lining up at the warehouse to withdraw bars. They're doing this for one reason: counterparty risk. The entity that took 1.3 million ounces out of JP Morgan knows something. They know that the paper price on the screen, $89, is a fiction. They know that the inventory reports are thinning. And they know that if they leave their metal in the vault, it might get encumbered. It might get leased out. It might get rehypothecated to cover the massive short positions of the banks. So they are taking possession. They are following the golden rule. If you don't hold it, you don't own it. But there is a deeper layer to this withdrawal that is even more bullish for the price. We need to look at where this silver came from inside the vault. In the COMEX system, there are two categories of silver: registered silver, which is available for delivery against futures contracts, and eligible silver, which is privately owned metal just sitting there for storage. Usually, when we see a squeeze, we watch the registered category drop. And indeed, registered stocks dropped by over 500,000 ounces yesterday. But the bulk of the JP Morgan withdrawal came from the eligible category. Why does this matter? Because eligible silver is supposed to be sticky. It is owned by long-term investors who pay storage fees to keep it there. It is not supposed to move. When eligible silver starts leaving the vault in million blocks, it means the old money is getting out. It means the long-term holders have decided that the COMEX is no longer a safe place to store their wealth. It suggests that the trust in the institution of the exchange has collapsed. And where is this metal going? We can make an educated deduction based on the global price map. We know from our data that the price of silver in China is hovering between $98 and $100. We know the price in New York is $89. That is a $1 arbitrage gap. If you're a strategic entity holding silver in New York and you can sell it in Shanghai for $11 more, you ship it. You drain the West to feed the East. The 1.3 million ounces that left JP Morgan yesterday are likely on a cargo plane right now heading across the Pacific. They are moving from a market that suppresses the price to a market that pays the fair value. This drain creates a mathematical limit on how long the suppression can last. The banks can print infinite paper shorts, but they have finite physical ounces. Every day that the arbitrage window remains open, another 2 million ounces leaves the system. At this rate of withdrawal, the effective available inventory on the COMEX will be critical within weeks. This connects back to the US mint suspension. The mint cannot find silver to make coins because the wholesale silver is being hijacked by these massive withdrawals. The retail supply chain is downstream from the commercial vaults. If the commercial vaults are being drained by whales, the river runs dry before it reaches the retail investor. You're witnessing a crowding out effect. The big fish are eating all the food, and the little fish, the retail buyers trying to get a silver eagle, are left starving. This creates a terrifying setup for the price. We are at 89.67. We are up 5% on the day, but we are doing this on vapor. We are trading paper contracts that represent metal that is rapidly disappearing. The JPM drain is the smoking gun. It proves that the smart money is not selling at $89. They are taking delivery. If they thought $89 was a bubble, they would be selling their metal into the market to cash out. They would be increasing the stockpiles, not decreasing them. The fact that they are withdrawing metal at all-time highs tells you exactly where they think the price is going. They think $89 is cheap. They think $100 is cheap. They're preparing for a repricing event that will make the current move look like a rounding error. So we have the government shutting down sales. We have the banks losing their inventory. This leaves only one variable left to analyze: the price. How high does the price have to go to stop the drain? How high does it have to go to convince the whales to put the silver back into the vault instead of taking it out? It has to go higher than Shanghai. It has to go higher than the street premium. In the next part of this deep dive, we are going to look at the Shanghai reality check. We have confirmed reports that physical silver in China is trading between $98 and $100. We are going to analyze this two-tiered market and explain why the COMEX price has no choice but to gap up to $100 immediately. The vacuum is open, the pressure is building, and the dam is about to burst. The mint is closed, the vault is open, and the wealth is transferring. We have arrived at the moment of truth. In part one, we watched the United States Mint close its doors because it could not figure out the price of silver. In part two, we watched the whales drain the JP Morgan vault because they did not trust the safety of the silver. Now, in part three, we're going to answer the question that is haunting every banker in London and New York. What is the real price of silver? If you look at your trading screen right now on Wednesday, January 14th, you see a number $89.67. That is the price that the COMEX computer says silver is worth. That is the price that the algorithms are trading. That is the price the media reports. But we have received a reality check from the other side of the world that proves that number is a lie. We have confirmed data from the physical markets in China indicating that silver is currently trading between $98 and $100 per ounce. Let that sink in. There are now two prices for silver on planet Earth. There's the Western paper price of $89, and there is the Eastern physical price of $100. This is an arbitrage gap of $11 per ounce. In the financial world, this is known as a broken market. An $11 spread is not an inefficiency. It is a vacuum. It is a black hole that is sucking every available ounce of metal out of the Western Hemisphere. Think about the physics of this trade. If you are a bullion bank, a refiner, or trading house, you're looking at a risk-free money printing machine. You can buy a contract on the COMEX for $89, take delivery of the bar, fly it to Shanghai, and sell it for $100. You make an immediate guaranteed profit of over 10% in a matter of days. This trade is happening right now. It is the reason the vaults are empty. It is the reason the mint is closed. The metal is flowing uphill to the highest bidder, and the highest bidder is China. This signifies a historic shift in the structure of the global economy. For 50 years, price discovery, the mechanism that decides what things are worth, lived in New York and London. The West set the price, and the East took the price. Today, that relationship is inverted. Shanghai is now the price maker. New York is the price taker. China is setting the price based on physical supply and demand, based on the needs of their solar factories, their battery plants, and their citizens protecting their wealth. New York is just trying to keep up, dragged along by the arbitrage. This means that the price of silver on the COMEX must rise to $100. It has no choice. It is a mathematical certainty. If the COMEX price stays at $89 while Shanghai is at $100, the drain will continue until the COMEX has exactly 0 ounces left. At that point, the COMEX defaults. To prevent a default, the COMEX must close the gap. The paper price must rise to meet the physical price. This is why we are seeing such violence on the charts. This is why we are seeing vertical candles. The market is frantically trying to re-prick itself to reality before the inventory runs out. And consider the inelasticity we discussed earlier. Why is China paying $100? Why aren't they waiting for a dip? Because they know the dip isn't coming. The Chinese industrial complex understands that silver is a strategic mineral. They know that without silver, they cannot dominate the green energy transition. They are willing to pay $100, $110, whatever it takes to secure the atoms. They are not speculating, they are hoarding. This Shanghai reality check explains the panic we saw at the U.S. Mint. The U.S. Mint usually buys its silver blanks from private vendors. Those vendors operate in the global market yesterday. The U.S. Mint likely called their suppliers and offered to buy silver at the spot price of $89. And the suppliers likely laughed at them. The suppliers said, "Why would we sell to you at $89 when we can sell to Shanghai at $100? The U.S. Mint got outbid. The sovereign government of the United States was priced out of its own currency market by the physical reality of the East. That is why they suspended sales, not because of a glitch, but because they refused to pay the real market price, and so they got no metal." This is what a currency collapse looks like in the early stages. It isn't just about the number on the bill getting bigger. It is about the goods disappearing from the shelves because the currency is no longer accepted as a valid store of value by the producers. We are seeing the bifurcation of the world, a paper world that is crumbling and a physical world that is repricing. So what does this mean for the price action in the next 24 hours with the Shanghai price hitting 100? The psychological ceiling for the COMEX is gone. Traders in New York know that $89 is a discount. They know that $90 is a discount. This creates a chase. Funds that are underweight silver, which is almost all of them, are scrambling to get exposure. They are buying the futures contracts because they can't get the physical metal. This pushes the paper price up. It creates a feedback loop. The higher the price goes, the more headlines it generates. The more headlines, the more retail panic. The more retail panic, the more the mint stays closed. The more the mint stays closed, the higher the premiums go. We are in a super exponential phase. And let's look at the gold price for confirmation. Gold is trading at 4,616. It is holding its breakout. If you apply the historic gold to silver ratio to the Shanghai price of silver, the math becomes even more explosive. But right now, the ratio is compressing. Silver is outperforming gold because the shortage in silver is acute, whereas the shortage in gold is monetary. Silver is running out of stock. Gold is just being revalued. The Shanghai spread is the ultimate bullish indicator. You cannot fake it. You cannot paint the tape in Shanghai to fool the market in New York. Physical metal is heavy, it is hard to move, and it doesn't lie. If buyers in China are handing over $100 worth of yuan for an ounce of silver, then an ounce of silver is worth $100. Period. The COMEX can print $89 on the screen all day long, but that just makes the COMEX a liar. And markets always punish liars. The punishment is the drain. The punishment is the default. We are watching the Western financial system being punished for 40 years of price suppression. They held the beach ball underwater for too long. Now it is rocketing to the surface, and it is going to hit them in the face. In the final part of this deep dive, we are going to look at the endgame. We are going to map out the path to triple digits on the COMEX. We are going to discuss what happens when the U.S. Mint finally reopens, if it reopens, and we are going to give you the final verdict on how to position yourself. When the paper price finally snaps and gaps up to meet the Shanghai reality, $100 is not a target anymore. It is the current price. You just haven't seen it on your screen yet. The future is here. It is just unevenly distributed. And right now, the future is in Shanghai. We have arrived at the conclusion. If you have been with me through this entire deep dive, you now understand the full magnitude of the event we are living through. You understand the sovereign default signaled by the United States Mint suspending sales. You understand the whale raid that drained 1.3 million ounces from the JP Morgan vault in a single day. And you understand the Shanghai reality where the physical price has already crossed the $100 barrier, leaving the COMEX trading in a fantasy land. The evidence is overwhelming. It is forensic. It is undeniable. We are not looking at a trading anomaly. We are not looking at a temporary supply chain glitch. We are looking at the end of an era. The era of cheap, abundant paper-derived silver is over. It died today, Wednesday, January 14th, 2026. Now, we must look forward. We must map out the territory that lies ahead. Because once the sovereign mint closes its doors, the rules of the game change permanently. We are flying into the vacuum. So, where does this stop? Is $90 the top? Is $100 the top? To answer that, we have to look at the psychology of the triple digit. $100 is not just a number, it is a barrier in the human mind. For decades, silver has been seen as the poor man's gold, trading in the teens and 20s. The idea of silver costing $100 an ounce seemed impossible to the average investor. But today, with the Shanghai price hitting that mark, the impossible has become the reality. When the COMEX price finally gaps up to meet Shanghai, and it will likely within the next 48 hours, it will trigger a global media frenzy. $100 is a headline that writes itself. It will be on the front page of the Wall Street Journal. It will be the lead story on CNN. And when the public sees silver hits $100, they won't think it is too expensive. They will think, I need to buy it before it goes to $200. This is the paradox of a GIF good or a Valin good. As the price rises, the demand increases because the rising price confirms the value in the scarcity. The United States Mint has just poured gasoline on this psychological fire. By suspending sales, they have told the public that silver is hard to get. Nothing makes a human being want something more than being told they can't have it. When the Mint finally reopens, whether that is next week or next month, do you think demand will be lower? No, it will be higher. People will be lining up to buy at any price just to secure a piece of the national heritage. So $100 is not the ceiling. $100 is the starting gun for the mania phase. But we must also look at the monetary logic. Why is silver rising? Is it just supply and demand? No, it is the dollar failing. We are watching a real-time devaluation of the United States dollar against hard assets. Gold at $4,016 confirms this. The drain of physical assets from west to east confirms this. The $50 billion bond sale by the Reserve Bank of India that we discussed earlier was the first domino. The closing of the U.S. Mint is the second domino. We are watching the sovereign crisis move from the bond market to the commodity market. When a government cannot borrow money cheaply and cannot source strategic resources, it is losing its sovereignty. It is losing its control over the economic destiny of the nation. This is why you must hold your position. I know the temptation to sell at $90 or $100 will be extreme. You will look at your gains and feel like a genius. You will want to cash out into dollars to lock in the profit. But you have to ask yourself, what are you locking in? You are locking in a currency that the U.S. Mint itself is struggling to price. You're locking in a currency that is being rejected by the BRICS nations. You're trading a scarce strategic monetary asset for an infinite depreciating political liability. Do not sell your silver for dollars. The exit strategy remains the same as we discussed in our previous reports, but it is now more urgent than ever. The strategy is ounces to assets. You hold your silver until the mania creates a distortion in the other direction. You hold until you can trade your ounces for land, for business, for cash-flowing real estate. Right now, at $90, silver is just catching up to inflation. It is just waking up, and we are nowhere near the peak of purchasing power. Historically, in the 1980 peak, it took roughly 800 ounces of silver to buy the average home in the United States. Today, even at $90, it takes thousands of ounces. We have a long way to go. The ratio of gold to silver is also critical. With gold at $4,600 and silver at $90, the ratio is around 51.1. Geologically, it should be 15 to 1. If silver returns to its natural ratio against gold, the price would be over $300 an ounce. That is the target, $300. Until we see the ratio compress, until we see the mania reach a fever pitch where taxi drivers are giving stock tips about silver miners, the trend is up. The week ahead is going to be chaotic. The banks will try to counterattack. They might hike margins again. They might try to spread rumors that the mint is reopening with plenty of supply. Ignore the rumors. Watch the data. Watch the vaults. Are the ounces coming back into JP Morgan? No, they are leaving. Watch the Shanghai price. Is China selling? No, they are buying. Watch the premiums. Are dealers lowering their prices? No, they are raising them. The fundamentals are locked in. The bridge is burning behind us. There's no going back to the old world of $20 silver. That world is gone. We are entering a new paradigm, a paradigm of resource nationalism and physical scarcity. The United States government just admitted they have a problem. They admitted it by closing the sales window. They showed their hand. Now it is your turn to play your hand. If you have silver, secure it. Do not keep it in a bank safety deposit box. Banks can have holidays too. Keep it in your possession or in a private non-bank vault. If you do not have silver, the window is almost closed. You're fighting for scraps. But even at $90 or $100, buying physical metal is better than holding paper that is burning. The sovereign default at the mint is the signal we have been waiting for. It is the confirmation that the system is broken beyond repair. The wealth transfer is happening. It is moving from those who trust the government to those who trust the metal. The mint is closed, the vault is open, and the price is vertical. Subscribe.